Thank you everyone for sticking around this afternoon. Vital Metals, we're Australian listed, so a little odd with a Canadian sort of asset up in the Northwest Territories on rare earths. I'm Geordie, I'm the Managing Director and CEO, recently appointed, and we've got a whole range of new people, new CFO, new VP of Exploration, looking at a new pivot for the company over the next few years. So, thank you for taking the time. We'll look at what we think in terms of why we think our assets in rare earths are on the world stage, why we think rare earths is good in terms of an outlook for commodity demand and price, and then look at the company in terms of what we're looking to do to deliver catalysts over the very near term and beyond 2024. We all see that. I'm just going to fast forward through there. When we're looking at it, basically put, we're an advanced exploration development stage company looking at a world-class rare earth asset in Northwest Territories. In particular, looking at Nechalacho light rare earth rich system, and the facets there are, it's large, it's at surface, it's got a low strip ratio, but also it's got a very good NdPr ratio to total rare earths, which is a particularly attractive commodity within the field of rare earth assets. It's large, so it has a large contained NdPr content, which gives potential for scale and scalability and duration. So those are the components we think that ultimately make it as an attractive asset for the long term. The other components are, drilling from 2023 has actually showed some pretty good results, outstanding results near surface or at surface, that show results of grade 50 to 80% above average resource grade are open and continue to be open for future exploration potential. So we're in place to deliver value add through the drill bit, but also other catalysts going forward. So we've got a catalyst-rich future. In particular, we're looking for an MRE update in 1 or 2 weeks' time. We're going to furnish a whole range of drill results, basically from Q2 onwards. And commensurate with the drilling, we're undertaking some primary metallurgical work, deployment work, to inform into a scoping study at the end of the year. So quite a rich, catalyst-rich year for us, from a range of reasons, and a de-risking future for us for our rare earth story there. Ultimately, there's good success around us in LithPower, looking at lithium potential. They've had a lot of good success finding and discovering a large lithium-bearing pegmatites. We know we have lithium-bearing pegmatites cropping out, but it hasn't been a focus for the company since we acquired the asset. So this year we'll actually pivot a bit of time and look at that potential as well, without taking the main focus off our rare earth asset. Why is Nechalacho so good? Well, it's large, for one thing. It has grade, and it's got a good ratio of NdPr to total rare earths. So this is a plot of NdPr grade versus total contained metal. The color looks at brown as first world jurisdictions, and blue is other jurisdictions. So for us, we're pretty well placed in terms of NdPr content, but also in terms of size and jurisdiction. So we think we're pretty well positioned. Unfortunately, bubble size represents market cap. And for us versus our peers, given some historical events, we've got a bit of catch up to do, but we think in terms of the new approach, the strategy, the catalyst driving forward, that we can play a catch up game versus our peers. Ultimately then in the big picture is, why rare earths? And I think rare earths are actually one of the fundamentally exciting components in terms of future supply demand scenario, in terms of growth, in terms of demand. And obviously we know that the picture there is becoming actually a more commonplace in terms of EV, wind power, silicon chip demand, driving NdPr manufacturing, NdPr demand. This is projected here by Adams Intelligence to look at, fairly significant rates of growth in terms of demand, but also commensurate sort of uptake in terms of price. So that's a component that we want to be, and we want to be in this space because of that underlying demand. For me, demand has been a very interesting picture for EVs. In the last 10 years, it didn't really exist, but then we start, and this is a graph looking at EV car sales for the last 10 or so years. We've seen consistent growth over each year that in fact have actually outperformed the actual forecast, which anyone who's been in the industry for a long time is very rare. So we've seen a very consistent growth, and growth largely in Europe and in Asia. North America is actually behind the rest of the world in terms of uptake, so that's the future growth. The US is the largest economy. We see big demand coming out of that. So this is the staple sort of demand picture that people are talking about. But certainly some themes earlier on in this session is technology-driven future. And I think there's a big drive for generational paradigm-changing demand factors for a range of non-traditional commodities, in particular related to the confluence of artificial intelligence and the Internet of Things. We're in the juvenile stage of the adoption of the Internet of Things. We hook our TV, our fridge into the Internet, and that's it. But that isn't actually. This is a far more integrated system to come, and there are some fairly substantial sort of projections in terms of what this expansion could look like in just a few years. So I think it's a very attractive component in terms of where we see overall broad-scale demand and change in lifestyle, from the integration and maturation of, smart sort of cities in industrial automation, from healthcare, carebots, robots, etc., smart homes, building automation, retrofitting current existing infrastructure. I think there's a very big part to play in what the future looks like outside the traditional sort of measures of EV demand, solar, wind power, etc. So I think we're in the right area for demand to go forward. So moving back to the asset and the corporate strategy, and sort of we tabled this as a new strategy in January, talking to the board and the management. So we're looking at focusing on our strengths, which are asset, jurisdiction, and capability. We have obviously a very large asset in the space, one of the, I think, the best undeveloped assets in North America. It's got grade, it's at surface. Jurisdiction, first of all, jurisdiction, obviously fiscal regime stability, but also if you're in the critical mineral space, there's a lot of government support in terms of concertining timelines for permitting, but also providing funding for infrastructure development, but also funding for other new infrastructure related to refining and production capacity. So we're in the right jurisdiction, but also the skill set advantage in terms of leveraging off our partners' skill sets in rare earths, but also leveraging off new advancements in terms of technology for instrumentation for flow sheets, certainly for mineral separation, but also method integration. So I think ultimately we're at the right stage to now look at what the economics of this potential project is. Need for vertical integration. Look, rare earths is a highly concentrated business. Very few producing countries, but also even fewer countries actually refining a metal. And obviously, there's just a couple there that dominate the space. That has changed since 2020, and certainly geopolitical winds call for vertical integration in North America, and that's happening. There are three separations plants actually being constructed in the US right now, and Energy Fuels offers a fourth. So we're seeing good demand. Look, it's vertical integration. We're up in the Northwest Territories, just off Great Slave Lake, so we can barge straight onto rail straight into North America. North America makes the most sense for us as a vertically integrated production opportunity. And this is something that's commensurate with the Minister of Natural Resources, talking about funding for critical minerals projects, but also tax incentives for projects, etc. So we're in the right jurisdiction. So now back to the asset, and we'll talk about that because that drives catalysts in the market. So obviously, this is our altered alkaline intrusion, very high grades for an alkaline intrusion, cropping out, low strip ratio, probably closer to 1:1. But it actually shows some very interesting things near surface, and that's internal grade variation on the upside relative to the resource estimates we have, but also focusing on other things like looking at internal grade variation within the larger body, but also other bodies that crop out that have grades of 8%, 6%, etc. So they can add to the process flow sheet for us. So we think we're in a good position to bring an integrated production story together in terms of a scoping study. We're going to try and add catalysts through the year because 2023 drilling was actually quite attractive. A range of very shallow results with high grades, 50 to 80% above the resource grade, and particularly open across the northwest up here along a 300 metre long front, but also to the south and to the east. So it's still open at grade. And grade's important because it drives margin. But grade integration into a mineral resource and a mining plan optimisation footprint gives you margin and de-risking for a potential operation. So we like that in terms of marrying de-risking and value add in a scoping study. And that moves to our point on scoping for scale and grade. So we're focusing this year on looking potentially to drill around expanding grade at surface, mainly in the northwest, also to the south and east. That adds to our mineral resource estimate we have planned for later in the year that will inform a mine plan, focusing at front-ending grade to de-risk front-end production. So that lowers your payback period, heightens your debt capacity, and lowers ultimately your operating risk by having higher grades. So commensurate with that, we're looking at building in a picture of optimized metallurgical work, middle element and mineral deportment work through the flow sheet. And our VP of Exploration has done that before on Strange Lake, so it adds value in terms of history and understanding where the risks are and de-risking that opportunity. So now it's about value creation and de-risking. So anytime you can create the same value for less risk, I think you're in a good position. So ultimately now looking at components that no one exactly looks at Upper Tardif before is these graphs at the bottom just show some of the tight correlations that we see that add to the picture of what is Upper Tardif and what are the relationships between the things that drive the economics. And that is neodymium, praseodymium, a very tight correlation that we see between these over the entire grade range. This is important because when you're looking at the processing options around these mineral commodities, you want to have an understanding whether the relationships exist at different grade intervals and how to plan that in a metallurgical deportment study, but how to also look at a processing flow sheet. We're trying to develop a theory here. So it looks like ultimately there's a very tight correlation. The gradient here is the gradient for the entire mineral resource across all categories, measured, indicated, inferred. So it looks like it's basically a very tight correlation. That's our thesis, but we'll have to look at the rigor behind that in the metallurgical work. It also shows and supports basically we're a very low heavy rare earth mineral system. Over the entire range, it's pretty much pretty low. We're a light rare earth system. Most of the rare earths are actually, in this case, captured within fluorocarbonates, we believe. Fluorocarbonates are exactly the same ratio as what is defined by this curve. So we think we're in a good position. Other components there where we're looking at what else could host rare earths, we see a very buckshot antipathetic relationship between things like zirconium and total rare earths, yttrium and total rare earths, phosphorus and total rare earths. So that's important when we're looking at assumptions to make forward for metallurgical domaining and processing. So we're in a good position, I think, in terms of asset scale, scalability. We've got a catalyst-rich sort of 12 months ahead, looking at grade through the drill bit, resource updates and a maiden scoping study, which produces potentially something at scale and shows scalability thereafter. So, just wrapping it all up there, looking, beyond the rare earths, we've got an opportunity. Obviously, we're on this corner here. It's about 200 k's away from Hay River, 90 or so k's away from Yellowknife. We can add some potential sort of exploration sort of flavour beyond rare earths. We'll put a bit of attention into this during summer to look at what's cropping out and drill some of these targets, and see what we can find there to the picture. But takeaway, I guess, ultimately is, and our investment thesis is focus on the strengths: asset, jurisdiction, and skill set. So for us, we have a large high-grade resource. It's at surface. It's defined within one pit. It looks like a very consistent grade distribution in terms of what controls the grade. We're going to target higher grades through drilling that seem to be open in multiple directions that provide a range of catalysts through the year. That drilling, any and all drilling post-2022 will be integrated into a mineral resource later in the year that will form a mine study into a scoping study in Q4 2024. So we think we're well positioned. We think we're in the right commodity set over the long run, and we have an opportunity for a large-scale asset that could be, could provide production for decades. So we think that's where we are. We think it's pretty exciting. We think we're in for a good run over the next number of years, where the ultimate sort of supply-demand for rare earths is particularly large, and we're very excited by that. So thank you.